Ladies and gentlemen, my name is Greg Michaelowski. Today's date is August 6, 2014. This is a technical look at the sterling versus US dollar. Let's start big and go small. By that I mean start looking at the weekly chart here, the big chart. If you look back at the high price that we reached in the month of July, the high price was the highest level going back to 2008. We moved above the 2009 high price, and the market spent a few weeks above that level, but then started to rotate back to the downside. Couldn't sustain the momentum to the upside, and in fact, over the last couple of weeks, last week, we fell below this trend line on the weekly chart. Now let's take a step in and take a look at the daily chart here. We know that our high price up here moved above the 2009 high, moved up to 2008 levels, and then we started to see the market rotate to the downside. And in the process, we started to see the price move below little trend lines along the way. But over this period right here, the move to the downside is rather mild. In fact, we've only come about 50% of this leg to the upside, this leg going from the March low of 2014, which isn't the low for the year. The low for the year comes back here in the month of February, may even be right here. But this March low was after a corrective move to the downside, also got near the 100-bar moving average. And so we've only come down to around 50% of that move. So not that far away from the high, even though the price is maybe 400 or so pips lower. But we are stalling near that 50% retracement at the 168.26 level. Currently trading, however, at 168.34. So that's in play, that 50% retracement level. In fact, looks like we went a little bit below it in trading here today. The other thing off this daily chart, I'm going to zoom in here, is this blue line, this 100-hour moving average, or I'm sorry, the 100-day moving average. The 100-day moving average is represented by the blue line, and that level currently comes in at the 168.67 level. We've been above it today. We went above it yesterday. We've been below it today. We've been above and below it really over the last 4 trading days, where the market's unsure of which direction it wants to go. When the market trades around a 100-day moving average and doesn't move away from it, that says to me it's looking for more information. And so traders have to just use the level as a level of resistance or support. And if the market moves above it, that's bullish. If the market then cannot move back above this trend line, that's bearish. And that's what we saw over the last couple of days. So we're more bearish because we are below the 100-day moving average. We do have the 50% retracement at the 168.26, however, to get below. And so I would characterize this action still as being bearish because we're below the trend line, we're below the 100-day moving average. We do have the 50% retracement level to get below, admittedly. And if we do, we're going to be looking down toward the 167.40 level and perhaps even down toward our 200-day moving average. That's a green line in this chart. And that currently comes in at 166.35.8. And then we'll reevaluate the situation. And so that's what the longer term chart is saying. Stay below the 100-day moving average, keep the bearish bias. Now let's take a look at the hourly chart and continue our drill to the downside. And here is the overlay of the current 100-day moving average at that 168.67 level. So you can see the action over the last couple days where the market moved above it here and then below it here and then back above it here and then back below it here. So it's been above and below that 100-day moving average. Again, a market that doesn't know which direction it wants to go. But in today's trading, we did get a little bit more momentum to the downside, helped by weaker data. We had manufacturing production, industrial production come out weaker than expectations, and that helped force the market to and through the 100-day moving average. And also the 100-hour moving average, that's a blue line right here. And that has been the trend to the downside. So off the hourly chart, we're also showing negative bias here from a technical perspective. Stay below the 100-hour moving average, and that's bearish. Here's a 100-day moving average. So really, right now, if I were to put a line in the sand for the sterling versus US dollar, and drill that line in the sand and say, what do we not want to go back above? It would be this yellow area right here. We don't want to see the price move back above that level. If it does, then all bets are off for the sterling versus US dollar bearishness, or negative bias here for that currency pair. We are consolidating near the low, and this has allowed the 100 bar moving average to catch up with the price on the 5-minute chart, drilling down even further. The corrective move off of the low price today has come around the 38.2% retracement, come around the low levels from yesterday's New York session, and we found sellers against that level, so that too is showing bearishness here, being below the 100 bar moving average on the 5-minute chart, now below the 38.2 and below the low prices from yesterday's trade. So that, what are we saying overall? We're saying more bearishness here in the sterling versus US dollar off the 5-minute chart, off the hourly chart, and off the daily chart as well. There is some work to do, and specifically we need to get below the 168.26 level and stay below that level. Not do what we did here 4 days ago, where the market fell below that level and then rotated back to the upside. We need to stay below that 168.26 level, and if we're able to do that, then I think we have a chance to head on down toward that 167.40 level on the downside at 61.8% retracement, and then maybe even head our way down toward the 200-day moving average, the green line in the chart below. It's one thing to talk about the potential rewards, and if we go below the 168.26 level on the sterling versus US dollar, that should lead to further downside momentum in this currency pair. But you also need to understand the risks. Where are you wrong if the market doesn't indeed start to move back to the upside? And to understand that, you need to go back to that 5-minute chart, you need to go back to the hourly chart, and I'm going to outline the 38.2 to 50% retracement of this move to the downside in trading here today. The price shouldn't go back above what I call this correction zone right here. It shouldn't move back above that 50% retracement level. We see the 200 bar moving average starting to come down toward that level in another hour or so. The market, that moving average should be around that 50% retracement level, and that also adds to the resistance on the top side where the price should not move above. In addition to that, if I go to the hourly chart and look at the 100-hour moving average, that level comes in at the 168.54 level, and you don't want to see the price start to move above that level again as well. That is this overlay on the 5-minute chart right here. So we know the potential reward. We know what we need to get below on the downside, including the 26 level. We've defined our risk area up here. Let's see what the market decides. My name is Greg Michalowski. Good fortune with your trading.